Even if the miners did 675%, that means silver did even more than that. So guess where you should be invested in the precious metals bull era?
We're setting it as historic precedent. Was it really that event that caused the rally to the war? The economy is going to start suffering pains. That's the abuse bonkers.
Okay, everybody, welcome to another episode of Talking Trades with myself, Kevin Wadsworth, and my friend and business partner there, Patrick Grimm. What are we talking about today? We're talking about the miners and precious metals bull markets or bull eras, and when you should be holding miners and whether or not you should be holding them right the way through the precious metals bull era. Is that a good idea, Pat? What do you think?
Yes. Okay. We're going to show you, of course, we're going to show you charts. I'm going to show you the evidence to support this case where we're going to outline the miner's performance relative versus gold and relative versus silver in a precious metals bull era, guys. And by precious metals bull era, what we mean is the miners are going up and the gold's going up and silver's going up nominally. That means price in fiat, but they're also going up versus the SPX. And this is often instigated by a stock market turn down. So what we have is we have rising unemployment. We have a stock market turn down, and that initially can drag down silver, gold, and the miners. It doesn't necessarily have to, but it could happen. But what happens is on the recovery side, with all that money printing, all the debt, everything there, the acceleration and all those macro factors to help support the stock market. Well, the miners, gold, silver, uranium, oil, all that stuff goes up and outperforms. So everything goes up together, even the SPX, the stock market, but all these commodities, they outperform. So that's a precious metals bull era. Let's look at the evidence, all right? Right here, I have the gold and silver miners since 1968. And I showcased here, I'm highlighting the precious metals bull era, just about there. Here I anchored it at the low of the miners. Of course, you can never say, oh, I caught the low. The goal is not to say when the entry could have been. It's just to show you the performance from not the trade, but for the peak to the low to the peak for the miners. Of course, I could clickbait this. If I have a mining company and I'll say, well, of the miners, the ensemble of them, they did 1,000%. Well, factually true. And let's say you let the guy choose a low here or maybe an earlier low, and then you let the guy choose the high. And did the 10 bagger. Cool. And then the guy says, well, look at that. It did my miners. If I pick the low that started the run in 2000s all the way to peak. Oh, look, our miners, they did 6 baggers, 675% they did. So that's clickbait, headline news, snake's oil type of percentage that people throw in your face. And while that could still happen, and I'm not saying it can't happen, is it going up fast enough? That's the question you should ask yourself. Is there another instrument in a precious metals bull era where this 1,000% gain is not enough, where this 675% gain is not enough, right? And that's what I'm going to look at right now, guys. Here is ASA priced in gold. So what I did here in the top pane, I squished there just the ASA chart, the gold and silver miners fund. Look at the miners priced in gold. Lower highs since forever. So and here I kept the vertical lines, even if there's precious metals bull eras, look at the miners' performance during that. From the start of that dashed line, vertical line, all the way to the end, it's lower. So in real terms, your miners, did they really go up? They did not. Here, they marginally went up. If I take exactly the low and the high of the miners, its best sequence of the precious metals bull era, it went marginally higher priced in gold, marginally. And you'll see most of the gains. Guess where they are, guys? They're at the beginning. And I'll show you a crazy chart at the end of this. You'll really say, wow, okay, I have to understand why this is happening. So the miners, their greatest moves is right in the beginning of it. The first 24, 35 months, it happens there, their move. After that, if anywhere you caught a little late there, you're looking, the miners trying to outperform gold. I'm going to jump in. Look, it went down 76% there. And after that, just kept going down and down and down and down and down. Same thing here in the 2000s. In this precious metals bull era, you had a crazy run here for the miners at the beginning in the first 24 months there. That's what it did everything. After that, it went sideways versus gold. So their own price chart, they kept going up, but gold went up as much as the miners. And you could make a case that with less risk because gold does not have a CEO that could run away with a girlfriend. There's none of that with gold, right? It's stable. You could just stack it. And after that, towards the end of the bull era, guess what? The miners started severely underperforming. Here's the GFC. They never really made it back up after that, but we know gold kept going up and up. So when you look at this evidence, it's hard for me to find a case. I know there's going to be certain miners are going to do fine, but it's hard for me to find a case where I could say that the miners are really the place to be in a precious metals bull era. Even if people say it's a leverage play on gold. Well, it's not really leverage play. It is maybe at the beginning a little bit, but after that, at best it holds its ground. At worst, it does like the 1970s. They just implode. Here I'm highlighting for you the time here for the miners. Here's the miners price in silver. In silver, guys, it did even worse. So they have a small spurt here, 31 months. And after that, they lost 87% of the value from peak to low. Same thing here in the 2000s. They lost 76% from peak to low price in silver. So tell me, even if the miners did 675%, that means silver did even more than that. So guess where you should be invested in the precious metals bull era for the entirety of it. It's not the miners. I'll show you guys a final chart just to show you this. The miners, they like the unemployment rate. They like economic turmoil. They like maybe lower input costs, right? Lower oil prices during a recession, right? Here at the bottom pane, I have unemployment rate for the miners. See, as the employment rate goes up there, and as soon as it peaks, so as soon as the unemployment rate starts unwinding, you could say that the economy is in recovery mode. The economy is peak unemployment, and now, okay, we're back on track, and the unemployment rate starts unwinding. That is exactly when the miners peak versus gold and silver. As soon as the economy starts recovering, maybe oil prices are starting to go back up and everything's doing fine. The miners, that's it. They stagnate. That fear money doesn't go in the miners anymore, but it still goes in the miners. Remember, the miners keep going up in price, but it doesn't go up as much into the miners. The markets are putting in that money in gold and silver to a larger extent, as proven by this chart that are going down here. Here again, the 2000s, look at that. After 25 months, unemployment rate peaks. Guess what happens? The miners peak versus gold and silver, right? So right from that point on, you could say, okay, it's time to switch back into my gold and silver instead of miners. And same thing here. Whenever unemployment peaks here, let's see how this unfolds. Capital rotation event. When the unemployment peaks and starts winding down, we're going to, of course, look at each individual charts, but that's probably going to be the area where you should swap back into gold and silver and forget about those miners. So the bursts for the miners, Kevin, they're short-lived. They're usually at the beginning. Does it have to play out that way again? Maybe not, but keep a close eye on the chart and don't let people tell you that gold and silver miners are leverage plays and that they're long-term holds. They're just not there. As you see by that chart, over long periods of time, the miners will just get destroyed there, priced in gold.
Yeah, it's brilliant stuff, Pat. I mean, personally, I do view miners as being a higher risk, and I prefer to hold the majority in the precious metals, gold and silver, and just keep a small portion for trading in the miners, because they can do extremely well, as the chart showed, particularly right where we are now at this point in the cycle. The miners have an opportunity to really, outperform, but the chances are that period of outperformance will be quite limited and probably run out before the bull era runs out itself. But if it's different this time, then that's fine, because you can continue to play the trades in the miners. So I hope that gave people a slightly different perspective, perhaps, to what you might find elsewhere, and something to think about. If you like this kind of content, don't forget to like, subscribe, hit the notification bell for much more like this, and we'll see you next time.